Because Asian stocks in the green this year, but our next guest says that the strong showing is highly concentrated in just 4 equities. We're talking Alibaba, Tencent, TSMC, and Meituan. Rishaad van der Linde is HSBC's head of APAC equity strategy. He says that dislocations, I should say, not seen since 2008's crisis, provide rotation opportunities. What does that actually mean? What do you rotate into, Harold? And the other thing is, and isn't that also essentially what we've been seeing in the US as well, where 5 stocks have been so dominant there as well?
Yeah. So, I mean, it's not a pure Asian phenomenon, but if you look at the Asian equity universe, it looks like it's up a couple of percent year to date, but there's massive divergence between markets, in markets. So Indonesia, Thailand down 20, 30%, China up 20%. Within China, you get a couple of stocks that really have done very well, and the rest haven't really gone anywhere. In India, Reliance has done very good, but if you take it out, the rest of the market is actually down 15, 20%, sometimes even more. So it's really a handful of really large stocks that have driven Asia higher so far year to date. And yeah, if you run a portfolio and you weren't in those stocks, then that's going to be pretty tough.
Absolutely. We're looking at a chart at the moment. It just shows how Reliance's huge outperformance, 147% up in essence, 146% up since that low in March.
Yeah.
Perhaps, flatters to deceive the overall index. Is that what we're getting in lots of other places? We talked about the US, but on other markets. And also, the thing is, have they had their day? And you mentioned rotation, you just alluded to some of that. But, I mean, is it a growth versus value sort of proposition?
No, I think we're going. So this dislocation that we see in markets, whereby only a handful of stocks really have driven everything higher, that happens normally. But what we see now is of historic proportions. We haven't seen this since 2008, and even if we then go further back into the future, you're going to go into the 1990s before we see this really. So this is of historic proportion. Well, what does that mean? Now, that means that if you're in those stocks that have done very well, you're probably happy to hold on to it. But we also have to assume that things start to maybe normalize. And I have no idea when that might take place. But if we get stimulus package coming out of the US, if growth is going to be a little bit better in 2021, earnings growth expectations look like things are going to be a bit better next year, then things will maybe normalize over time. And that means you might want to dip in some toes in those markets that have really underperformed, or those stocks that have really underperformed. Now, that is to a certain extent maybe cyclical stocks. Some of them will be value stocks. ASEAN markets have really done really bad. So you can maybe pick and choose some stocks there, whereby you say, listen, the underlying growth stories look okay, maybe driven by demographics and things that really don't change. So this is maybe the time to build to that. Not necessarily switching out of the ones that have done really well and going full on into those that haven't really done that well so far year to date, but maybe just on the margin playing this a little bit.
Well, Harold, one area that you like, one region, one country, is Thailand, despite the fact that that equity market is the worst performer in Asia, worse than the Philippines. So what are you seeing in Thailand? We've got the protests, we've got the demonstrations, they continue. Do you look through that political unrest then?
Yeah, to a certain extent we do. So it's the same actually for Indonesia. And as I said, we're dipping our toes in there. So we're just taking a little bit of position in some of these markets, and we've rotated out of China. Actually, it's for us a bit of an ongoing process. So we were heavy into China until mid-July. Then we put China back to a neutral, moved into Taiwan and Korea. Those markets have done reasonably well on stories such as 5G. So that's also structural stories. And now we're dipping our toes into Thailand and into Indonesia. Now, yes, there are people on the streets in Jakarta and in Bangkok for a variety of reasons. New bills are being introduced in Indonesia as well. So there's a lot of other stuff going on in those markets. But those markets haven't really fell further on the back of this. A lot of that is well known. It is priced in. And there will be certain companies that will pull through this. I mean, it's not that people are going to eat less, shop less, or anything like that in some of these places. So you want to build maybe some exposure to high quality names in those markets that simply are available now at much more reasonable valuations. And remember, China is up 20%, Thailand is down 30%. That means there's a 50% gap between these two markets that have emerged over the last, say, 9, 10 months or so. So that's a big gap. So, as I said, we're not going to say, oh, sell out of all those big names that have done so well in China and Taiwan and Korea or so, but just dip a little bit your toes in those stocks that, yeah, you feel comfortable with, but haven't really moved anywhere or actually are down quite a lot since the beginning of this year.
Okay, so does the same thesis apply then to 8 shares versus 8 shares? A shares versus 8 shares. You've got that performance divergence there as well. Part of that is the tech story as well. And if you want to get more exposure to 8 shares, where are you looking? What sectors?
Well, I mean, there's a whole bunch of sectors you could look at, but indeed, there are. The discount has narrowed over the last couple of years because these markets, Hong Kong and Shanghai and Shenzhen as well, have come much closer together. So that discount has disappeared, and now it has reappeared. So for the same company, we see different valuations. And for some people, that means, yeah, you could actually say, I'm going to sell out the Asian one, I'm going to move into the Hong Kong one. Hong Kong gives you decent exposure to China at a much lower price. So, yeah, you want to take a look at that. But I think you're going to do that on a kind of almost stock-by-stock basis, not so much by sector, but stock-by-stock basis, because that share difference differs for individual stocks. So you go through it and see where the biggest gaps are and where you say, well, these companies eventually should do okay. Yeah, go ahead.
Yeah, Harold, just very quickly, final question here. You're using something called a radar framework for allocation, a new radar framework. What is it? How does it work? And what are the results?
Yeah, it's actually not completely new. We've used it over the last couple of years, but the way we actually use underlying data is a bit different. That's why we call it new. So that's for a technical reason. But the radar framework seems to work quite well. And it looks at two things. It looks at the fundamentals that are going on in certain industries. So are earnings being upgraded? What is happening with profitability and valuations? And it looks at sentiment towards those regions. Are people selling them out? Are they underweight in their positionings? Are analysts really mostly having sell recommendations, or are they raising their recommendations? So it looks at sentiment, it looks at fundamentals, and then it tries to identify sectors that look pretty good. And again, you see wide divergence there as well. And we try to play that to a certain extent as well. So sectors that do very well and are widely loved is some of the tech sectors and some of the consumer discretionary names, and that's the Alibabas and companies as such. And then there are sectors that are really, yeah, they look to do a little bit better, but people haven't really looked at them yet. Parts of the industrial universe fits into that. So that's why we look for value at the moment.